All right, today we are going to go through one of my favorite topics when it comes to cash value life insurance, policy design. Something that we talk about all the time. It is my favorite thing when it comes to whole life insurance because you can maximize a policy for cash value. This is what corporations do, the elite, the ultra wealthy, and anyone can do it with any dollar amount. So what I want to talk about is policy design, but really the impact that the 7702 change in the industry as a whole has really affected policy design. And the first thing I'll state, whether you are in the industry or you're considering a policy right now, policy design has not really been impacted. So specifically what I mean is when it comes to policy design, your money is being paid into a whole life insurance policy. Now, the fun part here, which so many people are not aware of, is that when it comes to your money going into a policy, typically what do you think? If you're going to buy a life insurance policy, you pay a premium, and that premium buys you a death benefit. However, if you're going to pay any amount of money into a product, you can actually choose where your money goes. Your money can be directed toward the insurance premium. I'll often refer to this as the insurance expense. Dollars that are directed toward the premium piece do not show up in cash value, typically for the first year, and sometimes years 1 and 2. This depends on the company and product. The reason why is this is when the company is going to overcharge us for the death benefit up front. Now, as you continue to make premium payments, say it's $10,000, $1,000, whatever, beginning the second year or beginning the third year, depending on the company and product, those premium dollars will begin to show up in cash value. So a premium, typically when I hear the word premium and I think of my auto insurance policy, I think expense, flat bill forever. Whereas with this, yes, I have the word premium, but it does begin to come back to cash value, and I do earn dividends and interest on premium dollars over time. We're going to look at an example too. But then I can pay money toward this PUA rider, and I'll often refer to this as a cash dump-in. PUA, by the way, stands for paid up additions. That's the technical insurance term you would see if you're looking at a life insurance contract or an illustration. Dollars you pay here in respect to cash value show up in cash value. That's money you can access right away. That begins to earn the guaranteed rate right away. That begins to earn dividends. This is the key to accelerating the cash value component on a life insurance policy. Now, it does buy you some death benefit, but the primary purchase or the primary reason people put money into this rider is often to accelerate the cash value growth of a policy. So as I go through this, if you said, hey, Steve, I am interested in a whole life insurance policy and my main objective or main point of interest is the cash value. How do I maximize that cash value? And I'll even go as far to say that I don't care about the death benefit right now. A lot of people we work with express that exactly. And then they ask, or I'll ask the question for them, depending on their knowledge level, how much research they've done. Can I put 0% of my payment toward the premium and everything else toward PUAs to maximize the cash value? And the answer is, I wish. We cannot go quite that aggressive. And the reason why really has to do with limits that exist. When it comes to limits, I have 2 limits that I want to be aware of as a consumer, as a policyholder, also as an agent. The first limit is the insurance company limitation. Insurance companies will have limits on how aggressive they will allow one to go in respect to the premium and PUA component. What you'll find is with the larger mutual companies, like a Mass Mutual, Guardian, New York Life, or Northwestern Mutual, typically the most aggressive I can go is around a 10/90 split. So what that means is if I was paying in, call it $100,000 per year, let me rephrase that because that may seem high to some. If someone said, I want the ability to pay in up to $100,000 per year, but I do not want to get a bill for $100,000 because then it will feel like a burden. What if I can't pay it? What they could do is literally this. We would set it up where the premium is $10,000 per year. That $10,000 does not show up in cash value in the first year because the company is going to overcharge me for a death benefit up front. Whereas the PUA rider is optional. I can add money there if I want to, but I do not have to. That can be another $90,000 per year. Now, touching on those major mutual companies, some will allow you to go a bit more aggressive than a 10/90 split. So I can get that base premium maybe down to 9%. And some smaller companies will allow you to go even lower than that. There's a smaller company today I was modeling, we got it down to 5%. Still did not make sense to move forward with it for a number of reasons, but still my point is, when it comes to different blends, you can often go lower than 10%, depends on the company. My point is, limits, first limit is the insurance company in respect to my premium and PUA payment. So in a case like this, with $100,000, I'm billed for the $10,000, that's what I commit to, but I can add up to 90 depending on my situation each year. So has the 7702 change impacted those limits at all? No. And we're going to look at an example that demonstrates exactly that with one company here. The other limit I have, IRS limitations. So this has to do with a MEC limit on a life insurance policy. So the core benefits to a whole life insurance policy are what? It is a safe, liquid, and the third one, tax-free area to position money. Tax-free if I do things right. Any life insurance policy can become classified as a MEC. This stands for Modified Endowment Contract. If this occurs, what happens is my cash value will still grow tax deferred, but if I ever want to access my money and I have a MEC policy, it's taxable. I should rephrase. The gains are taxable when I pull it out. I also have a 10% penalty tax. It's ugly. I don't want it. Now, the fun part is it's easy to prevent, and here's how. Every policy has what is called a MEC limit, which is exactly what it sounds like. It is a limit that determines the maximum amount of money one can pay into a policy per year and still have their policy classified as a life insurance policy, therefore access the cash value tax-free and not a taxable investment. Here's the fun part. You, the policyholder, can actually set that limit wherever you want. And how you do that is when we actually design a policy, you will find that that MEC limit has a direct relationship to an individual's age and total death benefit. Now this video is about the impact of the 7702. So how has this impacted these limits? Well, what determines the MEC limit is still the age and death benefit. However, there's a difference now. And the difference is this. Since the 1980s, most life insurance companies, when it came to whole life insurance products, had a guaranteed rate of 4%. So all companies with their MEC limits are about the same. What that means is if you are a 40-year-old male and you wanted to use this example, you wanted to pay $100,000 per year in at a 4% guarantee, the MEC limit for $100,000, that would require a death benefit of about $2.8 million. Now, with this new 7702 change, what has happened? Guaranteed rates have come down. So, for example, if I have a guaranteed rate, not a 4%, because that's completely gone beginning 2022, if you already have a contract with a guaranteed rate of 4%, you're locked in, so you don't have to worry about that changing. But if you go with a company and product that has a guaranteed rate of 3%, what will happen is you would need a death benefit of just over $2 million in order to obtain that same $100,000 MEC limit. If the guaranteed rate was 2%, we would need a death benefit of a little south of $1.5 million to get the same $100,000 MEC limit. So I know that can be a little confusing. We've got other content that really breaks that down, but my point is, when it comes to policy design, now that companies have the ability to choose the different guaranteed rates they select, that ranges between 2 and 3.75%, there will be an impact when it comes to policy design. Now, This, the first limit, is the most important in my personal opinion when you really look at how to maximize the cash value of a policy. But we do need to make sure that we're designing it, if your goal is maximum cash value, that death benefit and MEC limit is not too high at a number we'll never hit, because that will cost us. It'll be a higher insurance expense, and it'll cost us in terms of performance. So it's good to be aware of that type of stuff, which if you're working with us, we're aware of that, and we can certainly go through that with you, or just make sure it's set up properly. If you're an agent, we do have our agent training business, which certainly will make sure that we train you and coach you appropriately. But let's look at some examples here. So what I want to start with, let's compare the old product with that 4% guarantee, how we would always design policies, and then the new product. This way we can see the difference. So old product first. Always start with the old one, what we're used to. We've got a life insurance illustration up here. Age 40 male. If I'm you, so let me rephrase. If I'm you, and I have the knowledge that I have in the insurance industry, my question would be this with a cash value life insurance policy. Where is my money going? When corporations are paying money into these products, that's what they're looking for. Where is my money going? How do I copy the wealthy, the corporations, to make sure everything is set up properly? Money can go where? Toward the premium. Here we go. $9,000 and change, just under $9,100. That premium buys me a whole life insurance death benefit of about $520,000. If we stopped there, that would give you a MEC limit with the old product. This is a guaranteed rate of 4%. That would give you a MEC limit of about $20,000, a little bit more. We have a MEC limit of $100,000 in this example. How we did that is this guy is a term insurance rider. Add those two together, and you get this guy down here. Your net death benefit of $2.8 million. Here's why I'm going through this. Based on the old products, pre-7702 change, an age 40 male, this $2.8 million death benefit gives him, guess what, from a MEC limit standpoint? $100,000 per year. That is the minimum death benefit needed to have the ability to pay in up to $100,000 per year. Now, back up to policy design. So that's the MEC limit. Premium, $9,000 and change. PUA. What's the difference between those two numbers? Do you notice a relationship? That premium times what? 10 is that figure. Off by about a penny. So this company will allow us to 10x the base premium in PUAs per year. So what we solved here for was a total desired payment of $100,000 per year. That's how much they wanted to pay in. And the absolute minimum premium, minimize expenses, and stuff the cash value. That's what this individual wanted to do. So as we look at the cash value here, what do you notice? Net cash value, $100K per year, only for 5 years going in, breaking even between years 3 and 4, 88 to 89% right off the bat. Now let's transition into the new one. Too many tabs up. Here we go. So, exact same product, but based on the new 7702 limitations. What do you notice about the premium and PUA design? Identical. The company has not made any adjustments there. In fact, I had a number of conversations with this company on those limits to see if there's any way we could make them more aggressive, lowering that premium further to maximize consumer value. And the answer is no, the limits have really stayed the same. In the first year, they do allow larger lump sums. This is one company. All companies are different, by the way. But the limits haven't changed, which is good for transparency. This way we can be very thorough when we communicate any information we receive from companies when changes occur in the industry. But what do you notice? That premium, there we go, purchases one a death benefit that is less than the example in the first policy we looked at, the old one, that had a guaranteed rate of 4%. This has a guaranteed rate of 3%. That premium purchases you a lesser death benefit. Now we still attach a term rider because all things are equal in this example where the individual, this 40-year-old male, wanted to pay in $100,000 per year. We're looking at the impact of the 7702 change. So if you're in a position right now, so we're shooting this video August 19th, 2021, you do have the choice to go with the old product or the new product, and we've got other videos that weigh out the pros and cons. The new product's fine, the guarantees are not as attractive. So if someone is really attracted to the strongest guarantees possible, that's where the guaranteed rate of 4% really is the winner in that respect. But there's pros and cons like any time. We never want to try and push someone to say, get in right now, it's a fire sale. Like, no, weigh the pros and cons out. That's what I would want to see if I am purchasing something. Don't rush me, just provide all of the information so it's transparent. But anyway, net death benefit, just north of $2 million. This is the minimum death benefit needed to do what? Give me that MEC limit of guess what? $100,000. Same thing with a premium and PUA blend. Look at that, 10x'd it just like the last example. Point here is all things are equal. When we look at the cash value difference, you will see a difference. So up front, there's less. This is the exact same product. The company, this particular company, did raise their PUA rider fee, which takes more off the top based on those PUA payments. Takes a little bit longer to breaking even between years 4 and 5 instead of 3 and 4. So there's little differences too that don't really have an impact on policy design, but they do have an impact on policies. And of course, we can always compare and contrast as well as we look at the different guys. Old, break even, new, break even, but we cover this in other videos as well. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.